Hello. In this lecture, we're going to talk about financing with a loan. We'll present some comprehensive examples that include loan financing. In addition, we're going to have a premature sale of the asset. The salvage value of the asset will differ from the book value, and we'll also have premature termination of the loan. And just to make things interesting, we're going to assume the situation of a small firm, so we have to use the tax table or the formula-based method for income tax computation. Let's look at our first example. We have a project that has an estimated life of 6 years. The operating revenue is going to vary from year to year. We're going to have a $300,000 asset that will depreciate with the MACRS specified percentages for the 5-year class. With this method, of course, we have to use a zero estimated salvage value for computations. We'll assume we have a loan for $200,000 that's going to be repaid over 5 years with 12% interest with equal principal repayments. In other words, we'll take the $200,000, divide by 5, and then repay $40,000 of the principal each year. For the small firm, we'll use the tax table or the formula-based method. And of course, we'll want to obtain the profit after tax and the cash flow after taxes. However, our project revenues were not as expected in our example, and we'll assume the project is terminated after 3 years with an actual salvage value of $180,000. Because the loan was used to finance the asset and the asset was sold, then we'll assume the loan balance remaining after 3 years was paid off. And of course, we'll want to obtain the entire cash flow over the life of our now shortened project. So let's work through the depreciation. Our $300,000 asset will have a 20% depreciation charge in the first year. This is the specified percentage for the 5-year class in the first year. And this, of course, reflects the half-year convention in year 1. So 20% on $300,000 gives us $60,000 depreciation. We'll subtract that from the book value to get our new book value of $240,000. In the second year, the specified percentage is 32%. We apply that to the $300,000, the original basis of the asset. To get our depreciation in year 2 of $96,000, that drops the book value to $144,000. Now, if we were to continue operating this asset through years 4, 5, and 6, and so forth, then the specified percentage in year 3 would be 0.192, resulting in a depreciation amount of $57,600, and in year 3, book value of $86,400. But because of the premature termination, we only get to charge half that amount. So the specified percentage in year 3 is half of the 0.192, or 0.096. That gives us $28,800 with the resulting book value of $115,200. Because we're selling this asset for more than the book value, we're selling it for $180,000 after the 3rd year. The difference between the selling price, $180,000, and the book value, $115,200, gives us a depreciation recapture of $64,800. That, of course, has to be added to the taxable income. Now, our first observation is that we must separate the loan payments into interest payments and principal repayments, because only the interest is tax deductible. When we obtain a loan, in this example of $200,000, that's a fairly large amount. That amount is not classified as taxable income because it's presumed that we will repay that amount. So any portion of the principal that's repaid is not a tax-deductible expense, but only the interest is tax-deductible. In our example, that's fairly easy to compute because we have a simple situation where the $200,000 is going to be repaid equally over 5 years, in other words, $40,000 each year. In the first year, our loan at 12% generates an interest payment of $24,000. That is 12% of the $200,000. So the total loan payment in the first year is the sum of these two, the $40,000 and the $24,000. And the loan balance drops to $160,000. In the second year, the loan balance of $160,000 generates at 12% an interest payment of $19,200. Principal repayment was fixed at $40,000, so the sum of $40,000 and $19,200 gives us $59,200. That's the total loan payment in the second year. The loan balance drops to $120. Then in the third year, the loan balance of $120 generates interest of $14,400. Together with principal, that's $54,400 for the loan payment. The loan balance drops to $80,000. Because we're prematurely selling the asset, we're also going to pay off the remaining loan balance. Usually the lender will want us to do that. So that's the remaining loan balance to be paid at the end of the third year, the $80,000. Then, of course, our loan balance drops to zero. And then, just as a reminder, the interest payment is the tax-deductible portion of the loan. So now we're ready to compute the taxable income and the income tax and profit after tax. We'll do this first for the years 1 and 2, and then we'll proceed in more detail for year 3. In year 1, our operating cash is $230,000. That's usually derived from revenues, and we subtract from that expenses like labor and materials to get the operating cash. Then we subtract equipment depreciation. That's another accounting expense. Interest payment, that's another expense to get our taxable income. So in the first year, the taxable income is $146,000. For our small company, that puts it in the range from $100,000 to $335,000. There, the marginal tax rate is 39%. So we take the excess above $100,000, that's the cutoff for that range. That's the $46,000, that's taxed at 39%. The portion from 0 to $100,000 is taxed at the other marginal rates, 15%, 25%, and 34%. The total tax for those portions is $22,250. You may have to look up in the tax table to remind yourself of that fact. We can then subtract the tax from the taxable income to get our profit after tax of $105,810 in year 1. In year 2, the computations are similar. The excess above $100,000 is $14,800. That's taxed at 39%. The other portion results in a tax of $22,250. That gives us the income tax of $28,022. Profit after tax, $86,778. In year 3, the taxable income from operations is $186,800. However, we have to consider the depreciation recapture, $64,800. That is also taxable income, and it's taxed at the ordinary rate. So we have to add these two components to get the total taxable income of $251,600 in the third year. The tax on that, again, is computed in the same way. The excess above $100,000 is taxed at 39%. The portion from 0 to $100,000 results in the tax of $22,250. The income tax in the third year is $81,374, giving us a profit after tax of $170,226. And then, of course, we have the column totals for convenience. Now let's do the cash flow. We've done this type of computation before. We have our profit after tax. That, of course, reflects depreciation with a minus sign in the arithmetic. So we'll undo that because depreciation is an accounting expense and it's not a cash flow. So we'll take the depreciation expense, add it back to profit after tax. In addition, we have to consider the asset investment. We spent $300,000 at time 0 for this asset. Also, when we sold the asset, we got $180,000 for it. Part of that is reflected in this computation, the depreciation recapture. That's reflected in here. The other part, the tax-sheltered portion of the salvage value, doesn't show up anywhere. That's $115,200, so we need to put that here because that's a tax-sheltered cash flow, and it's a very large amount. We mustn't forget that. And then finally, we have the loan principal cash flow. We received $200,000. At time 0, we paid back $40,000 each year in the first 3 years, and then at the end of the third year, we also paid back the $80,000 remaining loan balance, and so we have our total cash flow minus $100,000 at time 0, plus $125,810 at time 1, plus $142,778 at time 2, and plus $194,226 at time 3. We can also do a sanity check. We notice that the sum of the profit after tax, $362,814, is exactly equal to profit, the cash flow after tax, $362,814. And also the sum of the equipment depreciation column is the same as the sum of the asset investment, where we have the tax-sheltered portion of the asset salvage value here. Now let's look at example 2. This is going to be similar to example 1, but we'll assume that the loan is repaid with equal total payments. That is, principal and interest give us the same sum each year. So we have to compute that loan payment using the capital recovery factor for 12% over 5 years. So we apply the capital recovery factor, and we can either look this up in the interest tables or compute the formula. That's 0.27741. Apply that to 200,000. That's going to give us our annual loan payment of $55,482. And we need to split that into interest and principal. So let's go ahead and do that with this loan schedule. So here again, very similar loan schedule, but the numbers are a little bit different. $200,000 loan is going to generate, at 12%, $24,000 interest. The total payment is fixed, $55,482. We obtain that using the capital recovery factor. When we subtract the interest from that, that leaves us with $31,482 to reduce the loan balance. So now the loan balance becomes $168,518. Then in the second year, this loan balance at 12% is going to generate an interest payment of $20,222. The total payment, again, is fixed. That remains constant in this loan repayment scheme. So that leaves us with $35,260 to reduce the loan balance. The loan balance drops from $168,518 minus $35,260. It drops to $133,258. Then this loan balance of $133,258 at 12% generates this interest payment, $15,991. And we subtract that from our total payment. That leaves us with a principal portion of $39,491. We use that to reduce the loan. The loan drops to $93,767. So this is a slower repayment scheme compared to example 1. In example 1, we dropped this loan balance to $80,000 at the end of the third year. Because of the premature termination of the loan, we're going to pay off this amount at the end of the third year also. And then just as a reminder, the tax-deductible portion of the loan is just the column representing the interest payments. So now we're ready to compute the taxes. In a very similar manner, we have the operating cash. That column is the same as in example 1. The equipment depreciation column is the same. The interest payments are a little bit different because we have a slower repayment scheme. But the method is the same. We subtract equipment depreciation and we subtract interest payments from operating cash to get our taxable income. That's going to be a little bit different. Then, of course, the tax computations are going to be similar. Any excess amount above $100,000 is taxed at 39% year by year, and the portion from 0 to $100,000 results in a tax of $22,250. That gives us then our profit after tax for years 1 and 2. Of course, again, in year 3, we have to add the depreciation recapture to the taxable income resulting from operations. That gives us a total taxable income of $250,009. The income tax on that is $80,754. Again, the method is the same. Take the excess above $100,000, that is $150,009, tax that at 39%. The portion from 0 to $100,000 results in a tax of $22,250. Now we're ready to do the cash flow computations. We have our profit after tax. We again are going to adjust that with the equipment depreciation by adding back the equipment depreciation. We'll make the adjustment for the asset investment, a large $300,000 loan, cash outflow at time 0. The tax sheltered portion of the salvage value coming back, we need to add that at time 3. And then finally, the loan cash flow, $200,000 inflow at time zero, and then the principal payments increasing with time, and then the last payment, the remaining loan balance of $93,767 at time 3. That gives us our cash flow after taxes, and then in the third year, we add the two components to get the cash flow after taxes of $179,998. And then we can do the sanity check. The column for profit after tax is $361,220. That's the same as the sum of the cash flow column. And then, of course, the equipment depreciation column gives us the same total as the column for asset investment. Now let's look at example 3. And here we ask the question, what would happen if we didn't have this type of loan? Specifically, would the cash flow be larger, the same, or smaller than in example 1? Well, let's see what happens. Here we have the tax computations. They're a little bit simpler in this example because we don't have the loan. We don't have to split those loan payments into the two components. We simply take the operating cash. That column is the same. The equipment depreciation column is the same. To get our taxable income, subtract cell by cell these values from the operating cash. Income tax is computed in a similar manner. This company finds itself in the range from $100,000 to $335,000. So we have to find the portion of the taxable income that's above $100,000, taxed at 39%. The other portion from 0 to $100,000 is $22,250. That gives us the income tax, and then, of course, we get our profit after tax. And again, we're going to put the depreciation recapture in the third year. That gives us a taxable income of $266,000. Income tax in year 3 is $86,990, giving us a profit after tax of $179,010. And then we go to the cash flow. This is very similar. We take our profit after tax column. We add back the values for equipment depreciation, and then we adjust for the asset investment, the expense for the asset at time 0, the tax-sheltered portion of the asset salvage value here, and we get our cash flow. So the cash flow here is a rather large negative number, minus $300,000 at time 0. $180,450, that's larger than it is in examples 1 and 2. $194,490, again larger than in examples 1 and 2. And then $323 and $10 at time 3. And again, we can do our sanity check. This column gives us $397,950. That's the same as the last column. And the two middle columns give us the same sums. So let's compare these examples. The main thing, of course, is that in example 3, we didn't have the loan. So we have to come up with all of the equipment investment with shareholder money. So that's a much larger cash outflow. If we have larger cash inflows in years 1, 2, and 3, that tends to compensate partially for this large cash outflow. But let's do the net present value computation, and let's use 15% for the discounting of the after-tax cash flows. So we see that the sum of the cash flows is larger for example 3 than it is for the other two. For example 1, we have a slightly larger cash flow than for example 2. However, the net present value for example 2 is a little bit larger than it is for example 1. In example 3, lags far behind in net present value. That's because we have to have a very large investment at time 0, and we're getting some of that money back, but we're not getting enough back fast enough to compensate for that. So the net present value computation then is what the shareholders would look at to judge between these 3 different methods of asset financing. Example 1, equal principal repayments. Example 2, equal total payments. In example 3, no loan whatsoever. So let's start summarizing some of what we've been doing here. First, for the general case, in order to estimate the cash flow after tax, we have to take not only the profit after tax and adjust the depreciation expense by adding that back, but we also have to consider the asset investment. The asset investment being a large negative cash flow typically, and then we have usually a positive tax-sheltered part of the asset salvage value. And then, of course, we have to consider the loan principal cash flow, large positive cash flow when we obtain the loan, and then negative cash flows when we pay back the principal. Another observation we can make is that in many situations, financing with a loan can improve the cash flow after taxes so that we obtain a greater net present value. And most well-managed companies recognize this. We might ask, when can this happen? Well, there are two conditions for this. One is when the net present value of the project without the loan is positive. And we satisfy that in this example. And the other situation is that the discount rate that we're using, in our example we're using 15%, must be larger than the interest rate for the loan adjusted by the marginal tax rate. Our marginal tax rate is 39% in this example. So the effective after-tax cost of the loan would be 12% times 1 minus the 39%. So we satisfy the second condition. And you'll find many large companies and small companies that can satisfy both of these conditions. So that's what motivates them to borrow money. Of course, we want to avoid excessive borrowing because that puts the company in a risky position in case they don't generate enough cash flows. Then the banks or whoever's lending the money comes in and takes over. So let's summarize this lecture. The first important point is that only interest payments are tax deductible. So we must separate the loan interest payments from the principal repayments. The second point is that if you have premature project termination, that may lead to a situation where you get only half the normal depreciation. And quite often then, of course, you'll have depreciation recapture that has to be included with a taxable income in the year of sale. And the third point is that loan financing often improves the net present value of the cash flow after taxes.